What is Kraken investors? This is the video that takes 30,000 to a million. I got a lot to talk about. First of all, and out of the way, extended hours are in for Robinhood. So you're gonna have some time pre-market, extra time, and some time post-market after close to try to place in some trades. Now, when you do this, it's not dangerous or anything like that. Go ahead and do it. But the only danger is that you may need to do everything with limit orders. So if you're not familiar how limit orders work, I suggest you look into it. Basically, you tell the computer to place a trade only at a desired price that you set. So I would look into learning about that. Make sure you only do limit trades. Don't do market trades, because what happens is in the pre-market and aftermarket, the liquidity is very low, which means that there are not as many buy and sell orders available, not a lot of bids and asks. And so what happens is the difference between those two is very great. So if you're trying to buy something at where my index finger is, or right here, okay, where my thumb is, the only available price would be over here, way up high, right? The margins they're not that thin. The difference between the bid and ask spread, actually, it's called the bid and ask spread. So the larger it is, the less likelihood that you're going to get your desired price. And that difference, that spread, is controlled basically by how much liquidity there is in the market, how many market participants there are in that specific equity or fund that you're trying to trade at that very moment. So nobody is going to be active, virtually nobody, in those time periods, really, really early or really, really late after market close. So you may want to watch out. There could be some activity if there's some kind of news event that happens, like an earnings release or some other event that's stock related. Traders might jump in there and log into their computers and try to play some trades, see if they can play the market. And that's fine. Go ahead, but just make sure you do limit trades. So second of all, I'm going to review the account. I already did the first point. Okay, going out of order here. After I review the account, by the way, I'm going to show you all the positions as always. I'm going to do the investing tab. I'm going to show you the margin. I'm going to show you all the options positions, update you on the Smith & Wesson trade that I'm hanging my hat on. Okay. By the way, just because I'm doing this trade and I'm covering it in detail, don't sue me, okay? Like, this is not financial advice, for entertainment purposes only. If you decide to get into this trade, good. I'm glad you're going to make some money just like me. But, don't, just know that it's your responsibility. It's not my responsibility. You're placing this trade. So, anyway. So, with that out of the way, after that, I'm going to comment on something that interesting that Martin Shkreli said. So, for those of you who don't know who he is, he's this controversial figure. I kind of like him. He's kind of edgy. But anyways, I was just got recommended this clip, and he was talking about how over the long-term markets don't go up. And of course, the points he brings in are very potent. And I happen to disagree with him a little bit on some points. But for the most part, I think he brings up very, very good points, and I want to discuss those, at least a couple of them, for now, to finish the episode. So without further ado, I've wasted enough time with the introductions. I'm going to go into the account now, but stay tuned for that commentary if you want. If you want to skip the whole account review, just go fast forward until you see my face blown up like this. That's when I'll be talking about something else. All right, so going into the account now. Oh, no transition here. Okay, hold on. Going to the account. Now. Super smooth, right? Okay. So these are the options. By the way, I'm a new all-time high. So that's amazing. Very excited about that. I think I'm beating the market today, even in the regular hours. Let me see. 0.83. The market was up 0.36. So killing it. I'm not sure if I'm beating the market. Let's see how the Qs are doing. QQQ. The Qs are NASDAQ. So, yeah, about even with NASDAQ. Actually, I'm beating by 0.01%, so it's great. Most of the reason is this is without the aftermarket hours. So what happened in aftermarket hours? I received a couple of dividends from Main Street Capital and Realty Income, pretty fat dividends actually. So I'll share that with you. But this is just before market close. Now here are the option positions for those of you interested. I'm gonna scroll through it really quick. You can pause the video at any moment to try to figure out the exact position. So go ahead and pause if you need to. This is the controversial trade here. Well, not controversial, just highlighted. No, that's not it. It's this one. So I want to keep scrolling down. I had some good movement here. The Chinese ADRs did not completely disappoint, although they've been kind of weak. So I've started selling call options against this PayPal Leap contract, two of them. So we'll see how that goes. So here are my equity positions. I'm currently only holding 5 positions. The plus sign here means that the dividend is about to get reinvested, for those of you wondering. And of course, that will happen tomorrow. I have auto reinvest only on these 2 companies here, Realty Income and Main Street Capital. They've actually gotten a little bit pricey. So if we go to Realty Income, you'll see that it's sitting at 74.76, which is, I think, a little bit pricey. What I look for in this company when it comes to valuation, well, it's a fund based in San Diego, near where I live. What I look for is actually the yield. So the yield is like a cheat code to tell you whether it's a little bit overvalued, undervalued. If it's under 4%, then it's probably overvalued a little bit. It's probably priced pretty highly. So I would look to sell some call options against it, or sell some stock, reduce the position. And if it's if it's over 4, I think it's undervalued. So obviously this is kind of like a rule of thumb. It's not scientific or anything like that. But if it's like 4.5 yield, I'm jumping all over that. If it's anything over 4.5, I'm jumping on it. If it's anything between 4 and 4.5, I'll just stay put for the most part. But I really would rather not sell this fund ever. However, I do think it's pretty overvalued right now. Well, not pretty, but by a little bit. More, it's overvalued enough for me to start selling, or at least trying to reduce the position a little bit. So I've sold one contract at $75 and then one contract at $80. Okay, so that's Realty Income reaching the $74 or $75 level almost, and then Main Street Capital is getting a little pricey too. It's had a really big run in the last month or 2 months. I don't think it's worth $45. It almost reached the 40. I think she surpassed the $45 level. Around there, I sold 5 call options against it. So I'll be reducing this position by 500 shares if it stays over $45 by the 19th, which is at the end of this week. So that's kind of dangerous. I would like to keep the shares, so hopefully it stays under 45. But if it goes over 45, hey, I'll have some cash to work with. I may sell some puts at 45 level. We'll see what happens. But that's Main Street and Realty Income update. As far as Paramount, it's going up steady, which I'm really, really happy about. I'm trying to actually exit this position around the $29 to $30 level. I've sold $29 strike price calls, 12 of them, to cover the exact all of the position. Currently, that's sitting at a liability of about exactly $516, which will be erased at some point. The only question is whether I'll be keeping the shares or not, and I don't know. I'll be finding out on September 9th, barring my change of strategy, which could happen. I'm open-minded. Smith & Wesson's another curious and interesting case. I did an experimental trade, which may or may not pay off. I don't like doing experimental trades, but I felt like I needed some downside protection over the next week or two, because I think that tomorrow we're going to see some negative number, and probably for the rest of the week we're going to see some profit taking, which means downward movement in the markets. So I'm trying to hedge against that. This call option, this call credit spread expires on the 19th as well, at the end of the week. So we'll see if Smith and Wesson is below 15 at the end of the week, then I'll be winning. If it's above, then I'll be losing some or all of my collateral that I've put up. So that's unfortunate. However, in the long run, I'm looking to exit around the $15 level. As you can see, I've sold some calls here, 12 of them to be exact, covering the entire position. So I actually will not be breaking even. I'll actually be selling at a profit, mainly because I've sold call options on this position before, and I've collected some premium. And now it's the second round of collecting premium. And also, I think 15.63. Let's see where this break-even point puts me at. So the break-even price is 15.60. So I would actually be exiting a profit because of my previous trades. Although, if you just take this trade in isolation, I'll be exiting at a slight loss of 8 cents per share. So there you go. Let's see what else is there. That's the position here. Let's go to the account tab, the investing tab. I'm sitting at the lowest margin so far this year. I feel like I'm repeating myself every time I make an episode. I'm reducing margin, but it's only because the market is going up. So if I go to zero and if I actually have some cash sitting on the account, that would be a positive thing, I guess. I'm pretty neutral, actually. I'm just following, the standard procedure here. So I don't know, but 11.45 times 2, that's 22.9% levered up. So you want to multiply that by 2. Here's the stocks by total return. Apple, Main Street Realty Income. There's only 5 stocks now, so I feel like this ranking here, this kind of irrelevant. But you can see Apple is still, I sold 10 more shares today to try to de-risk a little bit. You can see that I have $123,000 worth of Apple still, and I do have some call options sold against 200 of those shares. I'll be exiting at 175 and 180 respectively on, let's see what type of dates, but just to go over the rest of the account, it's a lot smaller than Apple, right? It's got $37 is $37,000. The next position, which is Main Street Capital, which could be getting reduced soon, and Paramount Global 32, Realty Income at 27. All right, so let's try to go to Apple and see where my points of selling is at the 175 dollar level and at 177.5. So if Apple reaches those two levels, I'll be saying bye-bye to 200 of these shares. So we'll see if that happens. It's had a monster run, as you can see. Look at this in the month. Almost 15% in 1 month. That's crazy. And in 3 months, there was a little downturn here by 9%, and then another like 20% up afterwards. It's crazy. Over 20% up from the lows. So it's got a monster run. I think it's justified. I just don't know about short-term market dynamics. I think it's going to be a little bit interesting trying to figure this out. But anyway, all-time high. Super excited. Couldn't be happier of all-time highs. Now I'm going to talk a little bit about Martin Shkreli's, interview that he had with someone. It's just a clip, really. So, the guy himself, you can look him up on your own. But what I'm concerned about is what he says, like the argument. I'm not concerned with who said it. I'm concerned about with the argument. So what he's saying basically is that otherwise I'd be committing a fallacy. By the way, for those of you not trained in logic, like if you address the person and not the argument, you're actually, that's a fallacy. I forget what the name of the fallacy is. It's not ad hominem. It's something else. But anyway, what he's saying is that the market over the long term is actually does not produce returns. Even if you take an index as like the S&P 500, which has been the only index. I've talked about this many times before, by the way. Like in other countries, the US is an exception over very long periods thus far. Other countries have just been getting decimated over the long term. Even China was the one country that I was tracking that was kind of positive over like 20-year period. But even China is no longer positive. So if you held money over the last 20, 30, 40 years in most countries in the world, you've seen your holdings, your wealth actually go down. And that's, I think, even including dividends and reinvestments. So I've looked at those graphs. I had a big episode on that, talking about all kinds of countries around the world and their home markets and all that. So capital markets actually are, they go down. They don't always go up like people assume in the U.S. specifically. And I think that's one of the main reasons actually why there's so much like retail interest in stock markets in the U.S. is because in other countries it's not like that. If you put your money in there, you're basically guaranteed to lose. You're better off doing sports betting or something that you might have an edge on. So you see a lot of countries like the UK, Australia, but virtually every country really big on sports betting. I mean, the US is too, but one time I compared the number of market participants that have their own brokerage account in the US versus Brazil, and it was like 60, I don't know, like 70%, 80%, some really large number of citizens in the US, adult citizens, have a brokerage account, and only like 1% of people in Brazil do. So that's just gives you an idea of what the rest of the world looks like. And it's just the incentives are just so polar opposite of what they are in the US when it comes to investing in an overall index in the stock market that, it's hard to ignore. But anyway, what Martin was saying was that net of things like inflation and capital gains taxes and things like that, you're actually, in the negative or even very close to negative, even in something like the S&P 500. In foreign market indexes, 100% you're negative even before all that. But even in the US, right? Because if you take, like, for example, inflation that's like, 2-3 right now, 9% almost, which is ridiculous, right? So people, even though they're up in their stock accounts, they're losing massively to inflation. Well, actually, if you're in this S&P 500 this year, you're down. I'm up, but if you just invested in the S&P, you're down, like nominally, meaning before inflation, and then you tack on another 9% hit of extra purchasing power being lost. You're looking at like, let me see what the S&P 500 is at the moment, year to date. Well, actually, I can't look at year to date on this. Let's go to Yahoo Finance. But I think I can look at year to date on Yahoo Finance. Let's find out. I don't want to try this for free. What are you talking about? Okay, we'll just go to the S&P futures here, since they're easily accessible. So year to date, you were looking at, it doesn't give me percentage. What's wrong with this? What about if I go full screen? Is it going to give me a percentage? Year to date? No. It doesn't. Okay, all right. So you can see in the top left. Well, you can't see in the top left, but it says minus 9.78. So minus 9.78 percent in the S&P 500, and then you add another 90%. You're down 18% this year if you're just investing in S&P 500. Even if we break it even by the end of the year, you'll still be down that, inflation adjusted, you'd be down. And then let's say you want to take profits from previous years or whatever, you got to pay capital gains tax. And so now you're looking at a negative number, even though you might have been up a little bit, on your stock market account. And I think that's fair, but I just, here's some pushback that I have on this argument, these points, which are very strong and true. But I made another video talking exclusively about this, about why I think the market actually is going up, and is going to continue to go up. And it's probably one of the best inflation hedges and stuff like that, because historically during hyperinflationary periods and things and periods of economic stress and even high inflation periods, the stock market actually holds up. Because you're buying into cash turning businesses, right? So whatever the situation is, like if the input costs are higher, the output costs are also higher. So the market is kind of like the most sensitive thing The businesses are the most sensitive thing to inflation. Small businesses probably even more sensitive, but all businesses really, the cash comes through there first. Like if there's inflation in the economy, they feel it the most, and it's getting reflected nominally into their sheets. So even if inflation's taking a hit on their real earnings, real meaning included inflation effects, their nominal are going up, and even if it doesn't catch up 100%, it still at least protects you to a certain extent by growing the size of that business nominally. And it's not like you get a fixed salary, right? Like if you're a government worker or something, and then you have to deal with the inflation situation like in some other countries. For example, the country that I used to live and I grew up in, which is exactly what happened there. So number one, my counter argument number one is that the stock market is a great inflation hedge to begin with. Now, number two is I think that the stock market in the U.S. is such a hugely important, like that's the pillar. That's one of the main pillars of, capitalism and the symbol of strength for the United States. They also have a status of the reserve dollar that not puts the denominator, I guess, measure is the measuring stick. Sorry, the measuring stick, the ruler of the stock market, and that happens to be the world's reserve currency right now. And there's no candidates to overtake the dollar, even the slightest thus far. So that's automatically going to get bid in the dollar. So the dollar sees strength in weak economic circumstance, and the dollar sees strength into very strong economic circumstance in the United States, and that kind of helps it stabilize, the lower side of the equation here. But the main point is that the people who are in control, the banksters, the Federal Reserve, and the member banks, the banking cartel, basically, for lack of a better word, they're not going to let the stock market go down. They're just not going to let it. Like, it's going to be a national emergency, a huge national problem. This is a tennis racket pen, by the way. It was a gift. I don't know why I'm playing with it. So anyway, I think it's going to be a huge national problem, a huge issue, like the political issue. Just politically, it's not palatable for the market to go down. So they're going to manipulate it. 2008 was unacceptable, right? You saw everybody scramble to try to get the stock market to be up. Like they'll say things and they'll try to disguise it in other terms, like, oh, well, unemployment was bad or whatever, or we need to help people, families, and their houses, and all that's true. But they really want to see the stock market go up. They don't want to see rolling fatalities in the financial markets, in the financial sector. That's where all the cronies make their money, and all the connected people. Everybody many of the people who work for the Federal Reserve work for Goldman Sachs, for example. It's a revolving door over there. So they want to look after their own interests. So even if they have to sacrifice the real value of the market, real meaning net inflation, the nominal value is going to go up. Like they're not going to let it. They're going to cost the citizens, but they're not going to let the market go down. Even if there's momentary crashes, even as ones as deep as 2008, the market will always rebound as long as this kind of attitude and culture is ingrained, is in place in the United States. So that's kind of my pushback. Those are just two of the points. There are others, but let me know what you think about this argument. I'm really curious about you guys' opinion on the matter. All right, I'm gonna end it right there. All-time high. Super excited. Let me know how close you are, or if you've already scored some all-time highs this year. And if not, what's dragging your account down? That'd be interesting to hear. All right, that's it for now. Peace out.